Welcome to The Explainer. Today we're diving into the industrial giant Illinois Tool Works, or ITW. And you know, if you're an investor, ITW is this really fascinating puzzle. On one hand, you have this model of elite quality and consistency, but on the other, it has a pretty big growth problem. So let's break that puzzle down, piece by piece.
Okay, first, let's just establish that quality I was talking about. ITW is what they call a dividend king. That's a super rare club for companies that have raised their dividend for over 50 years in a row. ITW, they've done it for 61 years straight. And for an investor, that's not just a number on a page, right? It's a massive signal of incredible financial discipline and consistency through thick and thin, through every kind of economic storm you can imagine.
And that brings us right to the core paradox. I mean, those dividends are amazing, but the company's sales have been pretty much flat. And yet, at the exact same time, their profits are hitting all-time highs. So how is that even possible? This is the central question for anyone looking at ITW today, and we're going to unpack exactly how they're pulling it off.
All right, let's get into it. To understand the paradox, you first have to understand what makes ITW such a high-quality, profitable business in the first place, and it all starts with how the company is built.
So the company is incredibly diversified. We're talking 7 different business segments here. And what you'll notice is that no single piece of the pie is too big. No one business totally dominates the portfolio. From an investor's point of view, that structure gives them a ton of resilience. You know, if there's a downturn in one area, say construction, it can be balanced out by strength somewhere else, like in their automotive business.
So how do they run this diversified machine? Well, it's not just a random collection of businesses. It's like an ecosystem, and it's all powered by this really unique operating system they call the ITW Business Model. This is their secret sauce.
And this model really has 3 key parts that all work together beautifully. First up, you've got the 80-20 process. This is huge. They relentlessly focus on the 20% of their customers who bring in 80% of the profit. Second, they use that intense focus to drive what they call customer-back innovation. Basically, they go out and solve the biggest, toughest problems for those most important customers. And third, all of this allows for a decentralized culture where their 80 different divisions can move with the speed and agility of a small startup.
This quote really just hits the nail on the head. This whole system, this is their primary economic moat. We're not talking about a patent on some gadget. Their real competitive advantage is the entire way they do business, which is, as you can imagine, incredibly difficult for anyone else to copy.
Okay, so now we get to see how this brilliant business model actually creates the big problem, the paradox at the heart of the ITW investment story.
So for any investor, this is the chart that makes you go, huh? Just look at the top-line revenue. From 2019 all the way to 2024, it's essentially flat. There's been virtually zero growth in total sales.
But then, you look at this. Over that exact same period, their operating margins, basically how profitable they are on their core business, have just marched steadily upward, hitting all-time record highs. So you've got this wild picture. Flat sales, but profits are through the roof. How does that even work?
Well, the answer, and this is so important to understand, goes right back to that 80-20 model we talked about. The stagnant sales figure isn't an accident. It's a deliberate choice. It's not a bug, it's a feature of the system. They actively get rid of less profitable customers and products, that bottom 80%, which, yeah, it reduces your total sales, but it makes your margins soar by cutting out all the complexity.
So the big takeaway here is that for the past decade, ITW's whole game plan has been about one thing: quality of profit, not quantity of sales. They've been tuning up the machine, making it more and more efficient, but not necessarily making it bigger.
But here's where the story takes a turn. Management knows you can only squeeze so much out of the orange, right? You can't just cut your way to greatness forever. So they've launched what they're calling their next phase strategy, and it's all about tackling that growth problem head-on.
And they're not being subtle about it at all. I mean, for the first time in over a decade, the company is officially changing its main focus. The goal is no longer just about pushing those margins higher. Now, it's about making real organic growth a core strength of the company, right up there with their awesome profitability.
So you might be asking, okay, how are we supposed to track this? How do we know if it's working? Well, management has given us a brand new scorecard. It's a new metric for investors to watch called the Customer-Backed Innovation Yield, or CBI yield for short. This thing specifically measures how much growth is coming from new, patented ideas they develop for their most important 80-20 customers.
And this isn't some vague promise. They've put a number on it, a target. The goal is to generate 3% or more in organic growth every single year just from this innovation engine, and they want to hit that by 2030. This is the new benchmark. This is what will tell us if this whole new strategy is actually working.
So, let's bring this all home. What does this all mean for you as a potential investor looking at this company right now? Let's just boil it down to the bull case and the bear case.
All right, the bull case is pretty straightforward. You've got this elite, high-margin, cash-gushing company, and now they're trying to bolt on a brand new growth engine. If they can pull that off, the stock could be worth a lot more. Now, the bear case, the argument from the other side, is that this whole growth plan is a total question mark. It's unproven, and if it fails, you're left holding a very high-quality but low-growth company that's trading at a pretty full price. And that's a recipe for the stock's valuation to drop.
So, if you're going to follow this story, here's your cheat sheet. These are the 4 numbers you need to watch in every single quarterly report. First, that CBI yield. Is it actually moving up toward that 3% goal? Second, organic growth outside of auto. Can the other businesses start to grow again? Third, operating margins. Can they protect their incredible profitability while they're investing in all this new growth? And finally, capital allocation. Do they stick to their disciplined plan of giving cash back to shareholders through dividends and buybacks?
At the end of the day, it all comes down to this one big question. We know ITW is a proven, world-class, profit-making machine. That's a fact. But is this big pivot to growth going to be the start of an exciting new chapter? Or is it just going to prove that this old dog can't learn new tricks? The answer to that question is what's going to determine the future for ITW's stock.